In a Fox Business exclusive, JPMorgan chief global strategist David Kelly is here to spell out the signs and the dangers he is seeing. I am not against stimulus. I think there are people who are hurting terribly right now. That's not what this is about. We want to hear from you what unintended consequences will come from all of that money coming back into the system through these $1,400 checks and what you see out there.
Well, we've got to be careful. I mean, what we're trying to do here is reheat the economy at a record pace. I mean, it took us 10 years to get to full employment in the last expansion. I think we'll do it in less than 3 years this time around. So there's an awful lot of stimulus, and I, like you, I think it is good to help people who are who've really suffered through this pandemic. But we need to be able to apply the brakes pretty soon after, when the economy is fully recovered, because there's just a lot of money going to be sloshing around in the economy in the fourth quarter of this year. And I think, when you try and book a restaurant, you can't get a table, or you try to book an airline, you can't get a seat. I mean, that's real pricing power. And I think that's what's going to tell us that inflation is really moving up.
Almond butter, $7 a jar. Gosh darn it. Listen, prices are going up. And I'm eliminating tuition and healthcare from this conversation because those things always go higher. But everything else, and you can't tell us it's not, is climbing in price, whether it's incrementally or more dramatically, like oil. What signs specifically do you see along this road that we may not see right now that indicate here comes inflation?
Well, there are some things that economists look at. I mean, one of the things we look at for years is something called vendor deliveries. It's how long does it take manufacturers to get the stuff they need, and that is right now running at about a 3-year high. So that looks somewhat inflationary. We're seeing a lot of bottlenecks here. That's part of it. But the other thing is we can just see the demand coming down the road. I mean, this is an enormous stimulus plan. It's about, it's $1.9 trillion. But the key thing is it's about $1.2 trillion in the next 6 months. And to pour that amount of money into the economy, I mean, it will lead to a very fast recovery, the fastest we've ever seen from a recession, anything like this size. But it does carry with it the risk of inflation. And, why is that bad? A little inflation is okay. But if you have a lot of inflation, you push up interest rates. And then you think about, well, we've got all this government debt. If they have to finance it at normal interest rates, that could cause some problems here. So it's a real trick. I wrote a piece this week on LinkedIn called Boil Then Simmer. It's like cooking rice. You got to get the water really hot, but then you've got to cool it down to a simmer. And I'm just not sure whether Washington's able to do that.
Yeah, I know. But let me get to hourly wages. Do you expect to see hourly wages jump? And there's nothing wrong with that. We want people to make more. But that, of course, then means that employers have to raise prices.
Yes, I do. I mean, already, if you're looking at wages year over year, they're up 5.3%, which is not bad. And that does reflect a little bit of, people at the lower end getting laid off. And so there's a bit of a mix shift there. But what we also see is this $300 per week extra unemployment benefits. What that really means is that if you want to reopen your business over the summer, you want to hire people, you're really going to have to pay them at least $15 an hour to get them to do that. Because rationally, why would you give up a bigger unemployment benefit to get a lower wage? And so I think that will push up wages, and that will contribute to the overall inflationary environment in the fourth quarter.
When do you foresee the Fed will be forced, and they're all terrified? You heard Jay Powell. He's so scared to just say what we all know. And I don't think Janet Yellen's going to be any different, but they will be forced to raise rates to tamp down inflation, or at least keep it in check, will they not? When?
I think eventually they will. The problem right now is that they can't say they're worried about inflation, because if they do that, long-term rates will go up, and that will tend to slow the economy when they're trying to speed it up here. But I do think that when we get into early next year, they'll look back at the fourth quarter, they'll say there's some inflation. And the first thing they're going to do is not raise the federal funds rate. The first thing they're going to do is stop buying quite as many government bonds. And so you'll see long-term rates go up. So what I think we're going to see is a steepening of the yield curve, long-term rates going up before short-term rates. And that's got a lot of implications. Okay. That should help the financial companies, but not so much, technology companies or growth stocks.
Okay, I'm going to warn our viewers. Here comes the wonkiest question of all time. What do you read into the overnight index swaps action that historically precedes inflation?
Well, what we're seeing is traders don't believe the Federal Reserve when they say they're not going to raise short-term rates until 2024. Exactly. I mean, that's what they said in December. But traders just don't believe it because they see this inflation. They recognize the Fed is probably going to have to change its tune when this economy is healthy again.
Great to have you, David. Thank you very much. Don't say we didn't warn you. It is coming, folks. And that's not necessarily the worst thing in the world, but It will affect your pocketbook. All right. Thank you so much.